Right, hi guys, this is Adam Khoo here. So I'm going to do a quick market update about what's happening in the market for the last 1 month and year to date. So let's take a look at the S&P to begin with, right? So we know that from the beginning of the year, January to early May, we had a very strong rally in the markets, right? So the last 2 months of last year, we had a very quick bear market where the market dropped about 20% in just 2 months, and it reversed up very strongly all the way up to early May. And again, if you remember, what caused the bear market last year was the trade war. And the moment the Federal Reserve said we're not going to raise interest rates anymore, we're going to hold interest rates, that gave confidence back to the market. And of course, Trump tweeted that, you know what, I'm going to do whatever it takes to support the market. That gave the market confidence, and the market rallied very strongly for the first 4 months, or rather the first 5 months of 2019, all the way up. And then what happened was the market hit previous resistance. So there was a previous high over here, it hit the resistance, and from there the market started correcting down, right? So this is not surprising because remember, nothing goes up in a straight line. You can't go up every single month. You have to go down before going higher. It's the nature of the market. It's the nature of market cycles. So I've been saying for the last couple of months that, you know, every month the market's up. Don't expect this to happen every month. It will come down. So again, not surprising. So what caused this retracement or this current correction right now? Well, of course, if you read the media, they have all kinds of reasons. They say it was because of the trade war intensifying. Now Trump is saying China's not keeping to their bargain. I'm going to raise tariffs even more. I'm going to raise tariffs on Mexico, on India, and China's retaliating, and China is retaliating on the Huawei ban, so it's blowing up. And because of that, the market's been freaking out, and the market's been correcting down so far 8% from the high. But let me tell you something. As professional investors and traders, the most irrelevant question to ask is, why is this happening? Asking why something is happening is totally irrelevant and not useful. Because when you ask that question, you are approaching it from a victim mentality. You are kind of like blaming the market. Why is this happening to me? It's because of the trade war, I'm losing money. Because of Trump, because of China, you're blaming someone, which is not useful. So what is more useful as an investor or trader professionally to ask what is happening right now? What's happening in terms of the price action, in terms of the trend, in terms of the fundamentals of the companies I'm in, where is it likely to go, and what do I do? Based on my investment plan, based on my trading plan, what's the best course of action to minimize my risk and maximize my profits? So we're going to go into this right now. So stay tuned. All right, so you can see that, again, since the market started correcting in early May, we are down 8%. What's more significant is you can see there was a strong level of resistance and then support, which has been broken right here. So support has been broken. At the same time, you can see that the 20 EMA, which is the red dotted line, has crossed below the 40 EMA. So that's a signal of a short-term downtrend. So the S&P 500 is on a short-term downtrend right now with the 20 EMA crossing below the 40 EMA. At the same time, you can see that we have just broken below the 200 moving average, which is a pretty bearish sign. Right now, the 200 is still flat, but the moment it starts sloping down and the price can't get back above it, then we are in a confirmed medium-term or even possibly longer-term downtrend, which means we could go into another very quick bear market right now. It is possible. So where do I think the market's going to go? Again, we can't predict the future. But based on current price action, if nothing else comes out, like, if the Fed doesn't cut interest rates or Trump doesn't stop tweeting, if we continue on this path, there's a high chance that from 2752, the market would probably drop to 2600. So 2600 is the next level of support right here. So again, this was a previous support. This would be the next level of support. If the market can find support here and bounce back up, we could continue the trend. But if it breaks below the support, then whoa, right, we could go back down and retest the low of last year, right? So again, everything is possible. Now, remember that on an uptrend, a 10 to 15% correction is not out of the ordinary, right? It happens, okay? So again, right now we are down about 8% from the high. So if we fall all the way to here, we probably would be down about 16 to 17%, okay, which is still pretty healthy in terms of a usual correction. But again, if we go back down to 2350 or lower, then it's more than 20%, and then we're probably back down in a bear market again. But again, if that happens, so what? We don't care about it, right? So remember that even if we get back down to a bear markets don't last forever, right? Bear markets last typically anywhere from 6 months to 1.5 years. Last year was a short 2-month bear market. Could be slightly longer this time. I don't know, right? So the important thing is, what do you do right now in a short-term correction? What do you do if it evolves into a bigger bear market? What do you do as a trader? What do you do as an investor? Now, whether you are an investor or trader, the most important thing is to be totally unemotional, to detach emotionally. Because when you get emotional, you do stupid things, you make stupid decisions, right? So the most important thing is to think logically by sticking to your predefined investment plan and predefined trading plan, and stick to your exit rules and entry rules, regardless of what's happening, right? So let's talk about it from a trader perspective. As many of you know, I'm both a trader and an investor. I've got a trading portfolio and an investment portfolio. And when I trade both stocks and Forex, but primarily when I invest in good companies, right? Now, if you're a trader, it's very simple. Whenever you place a trade, you have a predefined stop loss and even profit target, right? So by now, in fact, your stocks that you went long would have hit your stop losses. So you should have gotten out a long time ago and be out of the market in terms of long positions. But as a trader right now, you can start taking short positions, because once the market is bearish, remember, a rising tide lifts all boats. A falling tide collapses all boats as well. So when a market is bearish, you can bet 7 out of 10 stocks will keep going down, regardless of their fundamentals, because the market in the short term is not logical. Market in the short term is emotional, right? So as a trader in the short term right now, you want to start taking short trades, go short on the market by whatever strategy or setup. So in my professional trading course, I teach setups like breakdown from consolidation, rally on a downtrend, so on and so forth, right? So you want to trade those setups as a trader. And again, for your long setups, you should have hit your stop loss, should have gotten out long ago. Simple as that. Now, from an investment perspective, what do you do? Remember, as an investor, we have done our research. We have bought fundamentally good companies. And so if you find that you bought good companies at a good price, and now the price is below your purchase price, what do? Don't freak out. Remember that in the short term, the stock price going up and down has got nothing to do with the company. That it's still the same company, making the same products, making the same profits, employing the same people. All right. So what goes, the price going up and down is purely emotional. So if you have bought good companies, there are a few things you can do. Number one, just close your eyes and don't look at it, because eventually, if you bought good companies, it's going to go higher. Okay. The second thing you can do is you can hedge your investments, which means that, yes, in the long run, it's going to go up. In a short term, it doesn't feel very good seeing the price go down and having maybe some unrealized losses. So that's when options come in. So what I do personally for my investment portfolio is that I hold my companies, which are good companies, but I buy put options. Put options allow me to profit as the market goes down, so I can make some short-term profits that I can then use to buy even more stock as the price goes lower, right? So let me show you very quickly, how I use it in my portfolio. All right, so taking a look at one of my portfolios over here, right? So you can see that year to date, YTD year to date, I'm up 22.27% for the year. And if you've been following me, you know that I was actually up 40% as of last month. So again, because of this correction, it's now down to 22%, which is again not surprising. I mentioned that I expect to end the year with hopefully 50% or 60% return, but it's not going to be a straight line. I'm not going to get 40, 50, 60% all the way, right? I expect it to go up and down. So sure enough, goes up 40% return, goes down to now 22% return, right? And we'll see where it goes from here. It could go lower again, but again, as an investor or trader, you have to expect these drawdowns, okay? So don't get emotional that, the market took the money back from me. It's part of the game, right? Enjoy the journey going up and down, and it's fine. So one of the things that I did to cushion the blow, because I could have had a bigger drawdown, right? So to cushion the blow, I use put options. Let me just show you. So for example, this is my portfolio app, which I'm running. You can see I have quite a bit of the SPY ETF over here. There we go. So there's a SPY ETF, and you can see that when the market went down, corrected down, you can see that I'm having an unrealized, this is the unrealized profit and loss, unrealized loss of $6,000, right? Now, am I worried about this? Of course not, because in the long run, the SPY ETF will always go up eventually, right? But right now, temporarily, it's down. So it's like down 6,000. So how do I buffer? How do I hedge this temporary loss? Okay, I use put options. So you can see over here, I've got a couple of put options I bought, and one of them is this one. This is the June put option with a strike price of 290. Okay, so what does this mean basically? Now this means that, you see, a put option is like an insurance policy. It's like you have a house that's worth $1 million, and fire is now coming to your house. You're afraid that the fire is going to burn your house down, and instead of 1 million, your house is going to be worth $500,000 in a couple of days. So what do? You buy insurance policy. You can buy fire insurance. So you pay a small premium to protect your house. So if the house burns down, the insurance policy will pay you the $1 million. So that's a put option. That's a great thing of put option, right? So I bought this put option that has a strike price of 290. That means with this option, I've got the right to sell my shares at 290. So right now the shares are from 290, it went down to 274. Currently it's at 274, but I still have the right to sell it at 290 because of my insurance contract. So because I've got this put, the insurance company, which is the person who sold me the put, now owes me $5,000, right? So my insurance contract is worth $5,000, and that is able to at least hedge or protect part of my temporary loss, right? Now, the great thing is later today, I'm going to exercise my put options, which means I'm going to actually collect the $5,000. It's in my pocket. Okay, and then I can use it to buy more shares. And in the meantime, this minus 6,000, that's fine. It's going to go up eventually, and I'm going to make money on it. So that's how I use put options. And you can see that I've got many other put options. I've got another one here, SPY combo put. It's another put spread, and that's making me about close to $800. Another put spread making me $195, so on and so forth. So as the market goes down, what you can do is a few things. Number one, as an investor, you could just close your eyes, Or number two, some people ask me, could I sell and hopefully buy back lower? Yeah, you could do that as well. But trouble with doing that is you have to be really good at your timing, because sometimes you sell hoping to buy lower, and the moment you sell, it goes back higher, and you miss the right up again, right? So that's a challenge there. Another option is you could buy inverse ETFs. Right, an inverse ETF is an ETF that is designed to go opposite of the market. So for example, one ETF is called the DOG, the dog. So when you buy the dog, when the market goes down, the dog will go up. And that again gives you short-term profits to hedge your long-term portfolio. What I like to do is I like to use, again, put options to do it, right? Now, besides buying put options on the SPY, I also buy put options on individual stocks, right? Like Boeing or Alibaba, which I'm holding, and it's kind of like going down temporarily. I bought the Boeing put option Alibaba put option to make me profits while the stock's going down, so it helps me to hedge the temporary downs of my stock. So that's what's great about it. I also sell covered calls, right? I sell covered calls to my stock. Like you can see Microsoft over here. I was selling covered calls, that made me some money, right, to kind of like make up for the fall in Microsoft. But I'm still slightly up on Microsoft as of right now. So what's my plan moving forward for my investment portfolio? Again, in my investment portfolio, I'm holding really good companies, fundamentally strong, and I know they're going to be higher in the long run. So in fact, this correction, this bear market is giving me an opportunity to again buy the stock at an even bigger discount. Now, having said that, I never ever buy shares when it's on a downtrend. Never, because never catch a falling knife, because cheap could get cheaper, low can get lower. So I'm gonna wait for the downtrend to find a support level and begin to reverse back into an uptrend to start adding shares again. So as of now, I'm not going to add any more shares into my investment portfolio. Instead, I'm going to be defensive. In other words, I'm going to again defend my portfolio by buying put options or by shorting the market to make short-term profits to make up for the temporary downturn of my long-term investments, right? So I give you an example, like I'm holding Boeing, right? Boeing is one of my long-term investments, and I bought Boeing somewhere about here, right, about 380. Those of you who have been following me know that I bought it at a much lower price, and I actually sold it up there just before that crash over here, and I bought it back over here, all right? Because I thought, hey, there's a strong resistance and support. I bought it over there, and now because of the trade war, Boeing's now being affected by the trade war, it broke below this support level. So once it broke the support, the next support is 334. So I expected it to come down to 334, and I said by coming down, what's going to happen, right? I'm going to make short-term losses on my stock investment. So I decided again to buy a put option to protect my Boeing shares to give me some profit as it went down. So let me show you where it is. Here we go. Yeah, so you can see this is the Boeing, the put, we call it a bear put option, where I bought a put at 355 and sold another put at 335. We call that bear put spread, and this spread has made me some short-term profits of $509 as it went down. So again, the more it goes down, the more money I'm going to make on my put options. That's going to help me to again hedge the short-term losses on my stock. At the same time, I'm going to take profits on my put options and use it to buy more Boeing shares at a lower price. But I'm only going to buy it when I see a change of trend. I'm not going to buy it when it's going down. All right, so let's take a look at the other positions which I'm holding or I'm watching. Now, a lot of you know I'm very bullish on China in the long run. And I keep saying that this current trade war is a great opportunity to buy China stocks or China ETFs at a huge discount, right? Because again, the bear market will end eventually, and the bull market is going to make you really rich from the Chinese market. Now, so let's take a look at one of the China ETFs which I use, which is the GXC. Okay, so if you take a longer term perspective, let me just kind of like zoom out a bit to 5 year. There we go. All right, so this was basically the high at 123.9. This is the China ETF, the GXC, which is listed on the US stock exchange, and you can see it went through a big bear market over here, and it made a double bottom, and then we had a very strong rally over here. So it looked like it was going to recover, and now again, because of the trade war flaring up again, we are coming back down again, right? So it can be frustrating, right? You say, oh, I bought it there, went up there, made money, it's coming back down again. Yeah, but don't worry, in the end, it will go higher. So I'm an optimist. I always look at these corrections and downturns as an opportunity to buy more shares, right? But again, I will not buy more right now. Why? Because again, it's on a downtrend, right? So never catch a falling knife. Only start to accumulate when you see it at a strong level of support or when you see bullish price action, higher highs and higher lows. Now, China is really cheap right now. The PE ratio of the Shanghai index is only about 11 to 12 PE, where the average is about 25 to 30 PE. So it's really undervalued. Hong Kong's PE ratio is about 10, it's about 10. Again, way below the 15, 18 PE ratio. So China's really cheap. But again, remember, in a short term, cheap can get cheaper, low can get lower. Don't catch a falling knife. So having said that, I see strong support at 82.23. That was where it bounced off the last time. So right now, as it's going down, I'm not buying more shares. Again, I bought put options on the Chinese market. So as it's going down, at least I'm making some money in the short term. I also sold covered calls on the GXC to make some extra income. So I'm waiting for it to go back to 82.23. If it finds support over here, or it can bounce off the support over here, goes back up, I'm going to start adding one more time. So we're going to watch and see what happens on GXC. Alibaba, one of the strongest companies in China. Again, because of the trade war, you can see there was the bottom, in a double bottom, went all the way up, doing really well, and then boom, all the way down again, right? So I'm holding this stock. I bought put options. Again, I'm making money as it's going down, waiting to buy back more shares if you can find support back at 130. So it still has some room to go down. Okay, but again, eventually, will it go higher? Of course it's going to go higher. Absolutely. Right, you can see the high was 211. Now it's 149. It could go all the way down to 130 again, but mark my words, it will go up to 211, 300, 400 in the future. When, I don't know, but eventually, right, it's going to be sorted out. I'm an optimist, okay? Eventually, like it or not, China is going to overtake the US in terms of growth and already in terms of growth, in terms of market size and innovation. So you got to be in stocks like, Alibaba and Tencent. Okay, so the other one again is Tencent. This the other mega giant, a mega tech giant in China. So you can see all the Chinese stocks, because of, again, they flare up in the trade war, the uptrend, now it's back down again. So again, it could go back and test the lows. You never know, right? Now, important thing is to always remember that when you buy stocks, you're buying pieces of companies. You're buying these money-making machines, and nothing has changed. They're still making money. They're still growing. The only thing that has changed is the short-term emotions and perceptions in the market. So as a successful investor, you have to disassociate the fear, the emotions from the value of the company. And that's why it's so important to calculate the intrinsic value of the stock. Because once you know the intrinsic value, once you know what it is worth, you have the confidence to hold the company. Once you know that the index will go up in the long run, eventually you have the confidence to hold it and to make money in the short term by shorting the market or by buying put options. Okay, so you always win in the end if you follow these rules. So again, Tencent could be coming back down, opportunity to buy lower again. Let's look at some US stocks. Facebook, all right? If you take a look at Facebook, Facebook's actually been holding up pretty well. Why? Because Facebook has nothing to do with China. It's already banned in China, right? So people think, what the F? I don't care. So you can see Facebook recovered very nicely after, this was caused by the data scandal, all right? See, that the data scandal is temporary. It's a great time to buy Facebook. So I bought a lot of Facebook over here, making good money on Facebook. And of course, the overall bear market has brought Facebook down, but not that much. Because again, Facebook has little to do with China, so it's holding up pretty strongly, all right? And right now, it's at 177. The last I calculated the intrinsic value for Facebook based on my intrinsic value calculator, which that my students use, the intrinsic value is $226. So in terms of valuation, I'm confident Facebook is worth $226. So once you value the company, you know that Right now at 177, it's cheap, right? It's undervalued, so I'm holding it still. But again, it broke below the 50 moving average, so it could go back down to find support at 172, which was previous resistance. So if it goes back down again to here and bounces, I'm going to accumulate more shares before it goes all the way back up above intrinsic value. So as you know, one of my other favorite stocks is Amazon. You gotta own Amazon. They're taking over the world with their evil leader. I'm just kidding. But the guy does look like Dr. Evil, all right? With the bald head, and all he needs is a cat, all right? Okay, so look at Amazon, right? So Amazon, you can see, was on a downtrend, trade war, went sideways, reversed back up to an uptrend, and now it looks like it's breaking down again, right? So broke below the 50 moving average, going down. It's now selling at 1775, Amazon, right? Again, as an investor, do I care? I don't care. In fact, opportunity to buy more shares at a lower price. But again, like I said, I'm not going to buy as long as it's going down. 1737 will be the next level of support. If it breaks this, then it could go to $1,500. So if it goes back down to here, strong support, I'm going to definitely accumulate more shares at 1573. If it doesn't break the support, reverses back here, I'm going to start buying over here. And again, Amazon is a great company and really rare that it's selling at a discount. If you check out the intrinsic value calculator on Amazon, I did show it in one of my previous videos, right? You can see that based on its most recent cash flow, operational cash flow, its debt, short-term investments, and growth rate, the intrinsic value is 2,486, about $2,500 intrinsic value. That's the fair value, the true value of Amazon based on its cash flow generation, and it's now selling at 1775. So it's selling at a great discount. So again, great opportunity to accumulate more shares at a discount, but you gotta wait for it to be a strong support, wait for the trend reversal. All right, so I do hope that this little video has given you an insight on how investors look at the markets, how traders look at the markets, how we make decisions based on fundamentals and price action. And we don't care about why something has happened. We don't blame anyone. We take responsibility because we know that if we stick to our investment plan, our trading plan, in the long run, our stocks will always be higher. Our account will always grow. But in the short run, you must have the temperament to be able to withstand the ups and downs. If you can't take the heat, get out of the kitchen, right? You gotta take the volatility and have the flexibility to use tools like shorting the market, inverse ETFs, and put options to profit during the downtrend to make extra money to buy more shares at a discount. So this is Adam Khoo. May the markets be with you. Keep watching, keep subscribing. See you soon. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.